Good afternoon, everyone, and thank you for joining us on this BH&HPA webinar. My name's Ian James. I'm the National Chairman of the BH&HPA, and today I'm standing in for Debbie, who is currently at the Labour Party conference, hopefully catching Rachel Reeves' ear. As Chair, I've been keen to offer regular webinars for members. It's an easy and quick way for us to stay connected and up to date with industry and association news. This year, we've hosted 13 webinars on topics from inheritance tax to sustainability, and they've been watched well over 1,000 times. If you missed any of the association's webinars, you can catch them on demand on the members' website via the Learning and Support section. Following this webinar, the next one will be the Director General's Autumn Update, taking place on Wednesday, the 12th of November at 2 o'clock, so please do save that date. Now, did you know we have nearly 200 associate members in our association? Our associate members, like Eureka Capital Allowances, offer products and services that are especially relevant to businesses operating in UK parks industry. Many of them have decades of experience in our sector. Associate members can be found via the printed directory published every year, as many associate members support our magazine by advertising in the journal and sharing their expertise in journal articles. You may also search for associate members via the online members website via the suppliers directory. And of course, you can meet associate members in person at many of our branch meetings at our annual conference. Now, today we're going to hear from Jason Batty, the founder of Eureka Capital Allowances. Jason is going to help us to understand and perhaps access some capital allowances. But quickly, first of all, I'd like to congratulate Jason on winning the Business to Business Services Award at the recent South Wales Business Award ceremony. Over to you, Jason.
Well, thank you for the introduction and thank you for the congratulations, Ian. Really appreciate that. And thank you all for tuning in for this webinar. I'm just going to attempt to share my screen. The presentation should last around about 20 minutes, and I think we have some time for question and answers further to that. However, our contact details will be available to you. So if you wish to speak with us directly, please feel free to do so. So my name is Jason Batty. I'm the founder of Eureka Capital Allowances. And what we want to do today over the next 40 minutes or whatever the time that we have is discuss where parks are missing out on capital allowances and explain them a little bit better for owners. So before I go into the details of capital allowances, just trying to, there we go. So, who are Eureka? So, we are an independent capital allowances company. We're based in South Wales, however, we operate nationwide, and we're a team of capital allowances specialists and surveyors who have worked together for almost a decade now. We've supported hundreds of parks nationwide. The core of our business has always been hospitality, whether it's hotels, holiday lets, but holiday parks has been our biggest market, and where we secured millions of unclaimed tax relief for park owners, from small family run to wider corporate with multi-sites. And we've aligned ourselves with key organisations within the sector. We're very proud to be associate members of the BH&HPA, where we have been for quite a while. So we've helped a lot of members nationwide. Do apologise, my there we go. Our reason why, what we do, we give business owners and accountants a better understanding of how to maximise and utilise capital allowances as a means of protecting profits. But that's a brief introduction to us, and that's enough about us. So we'll get down to it. So what are capital allowances? Most people will be familiar with capital allowances. It is a form of tax relief. The modern era of capital allowances began during the 40s, when the government wanted to incentivise owners to invest in spending on their businesses. So they gave them the ability to claim capital allowances tax relief on qualifying items that are essential to the running of the business. So in qualifying and identifying and claiming these capital allowances, it creates a pool of tax savings that businesses can use against their profits as a means of reducing their tax liability in future years. Now, when people think of capital allowances, they think of plant and machinery, and it's quite common for owners and just people in general to think it's singular assets, such as a tractor falls under plant and machinery. However, it goes way beyond and way more further than that. So it also includes embedded fixtures. Now, embedded fixtures is a term phrased for anything embedded to the actual building itself. So I'll come on to where it fits with the holiday park in a minute, but say, for example, we picked up a building, turned it upside down and gave it a shake. Everything that remained fixed to the building itself will typically qualify as capital allowances, plant and machinery, and embedded fixtures. Now, the issue that we see a lot of the time with parks is that they're missing out on fully claiming their embedded fixtures and their capital allowances. And ultimately, in underclaiming, then you're overpaying in tax. So there's thousands of being missed in parks. And why parks are missing out is the first and foremost is the assumption that accountants and advisors have already claimed all the capital allowances. Now, in some cases, we see that it is rare, but we see the accountants have claimed absolutely everything, but that tends to be with your big accountancy practices, your big four. In some cases, we see that just the basic and obvious has been claimed. That's more often than not. And in some cases, nothing has been claimed at all. Now, a capital allowances specialist and an accountant are two completely separate things. They're different things. And we work with accountants. We don't work against them. A lot of our referrals happen to come from accountants. So we like to work with accountants, but there are many complexities that come with capital allowances. And one of the biggest misconceptions around why parks miss out is that there's confusion that a lot of accountants believe that upon making a capital allowances claim, it can affect capital gains tax upon disposal or upon the sale of the park. Now, this is only relevant if a park is sold at a loss. So we do come against that quite often. We also see parks miss out quite commonly, which on annual investment allowance, whereby this gives owners the opportunity to claim full 100% tax relief up to £1 million on any expenditure if they make the claim within the year of the expenditure. We see this missed commonly. So I would really, if you've spent money recently, I would highly recommend that being looked at to ensure you don't miss out on key AIA. Ultimately, parks miss out because to really delve into the detail and to identify the hidden assets on parks, you really need surveyors that have been trained in capital allowances to identify this. Whilst accountants can have a look at it and pick out, as I say, the basic and obvious, all too often there's way more beyond that. Okay, so that's where parks miss out also. And additionally, sometimes accountants or their advisors are not too confident through a full capital allowances report, a detailed one, because this needs detailed breakdowns and comprehensive due diligence, which, again, that doesn't fall into the remit of many accountants, so it doesn't give them the confidence to make these specialist claims. So why do capital allowances matter to parks at the moment? Well, Ian touched on it at the moment about Rachel Reeves, and there's so many taxes at the moment, which is, the implications are increases to corporation tax, IHT reform from April, and who knows what is around the corner. That's affecting park owners, the cost of living, energy prices and all sorts. It's not just affecting the parks, but the visitors themselves. So it's been quite turbulent for some parks with late bookings because obviously they're affected by the visitors' bookings. So it's crystal ball time as to what's going on. And these are having effects on the parks. And obviously tourism levies, another effect. So there's reasons, the financial squeeze on parks at the moment is coming from all angles. But why capital allowances matter to parks is that this can provide, in making capital allowances claims properly, it can create a pool of tax savings that can reduce your tax liability in future years. And in some cases, it can also generate cash rebates immediately, which obviously help with cash flow. It's a means obviously of reducing tax liability in future years, and it gives you the opportunity to invest in other areas. So we can sort of eliminate, by making capital allowances claims, can hopefully reduce the negativity of the other implications from the financial challenges that are being faced by parks at the moment. Now, there are two key capital allowances opportunities which when we analyse things are commonly missed. Opportunity one are known as capital allowances cost claims, which relate to development, refurbishment, and improvements of the site. So commonly missed areas. I mean, some of these can be picked up by accountants. Typically, if you speak to your accountant, they'll say we claim capital allowances. But as I mentioned at the start, this can sometimes be the very basic and obvious. So what we would recommend is just having whether it's pick a capital allowances company, whoever it might be, and try and get a free review. And it's not treading on toes, it's just to ensure that you're not missing out. So when it comes to underground utilities, for example, excuse me, throughout all the park, there is a skeleton of utilities which include water, electric, telecoms, and things like that. And again, we see just the basics of, being claimed upon with that, if at all. When it comes to fixtures and fittings in reception blocks and office blocks, counters qualify, fixed seating qualifies, flooring, that can be overlooked. Water and electrical installations to all buildings, I guess that's relatively self-explanatory, but park installations, the things above the ground, the connectors, the connections, anything above the ground relating to water can qualify. Signage, the signs at the gates, the speed signs, the amenity signs, things like that. Now, when we go back to embedded fixtures, as I mentioned, within a building, these are things outside of the building that are still fixed, and that's why most of them will qualify for capital allowances. As we go further down the list, obviously we've got fire prevention, you've got hydrants, alarms, and so on. Shower amenities, you have the sunscreens, the shower screens, the fitted mirrors, soap dispensers. When it comes to swimming pools and leisure gyms and so on, the pool heating, the extraction units, there is so much that goes into it. Obviously playgrounds, and then site lighting all across the site, road lighting, signage again, sewerage pumping systems, and much, much more. So there's a lot that can qualify for capital allowances cost claims which are overlooked. So highly recommend taking a look at that and delving further into detail. When it comes to cost claims, claims can be made, historically, providing this evidence of the expenditure. If you're a company, this typically comes in the forms of fixed asset register. If you're an individual that's trading, you might have it in an invoice listing or some sort of spreadsheets. The devil's in the detail. Part of the capital allowances consultancy's job is to analyse every pound spent to make sure that nothing has been missed. So opportunity number one that we see commonly missed are cost claims. Opportunity two, which most owners are oblivious to, are pre-2014 acquisitions. This relates to qualifying items that were already at a park upon the time of acquisition. Now we're going back 10, 11 years. Surveyors are essential to identifying these items. Whilst with a cost claim, I've just listed some of the items and spoke of them that will qualify. You typically have receipts for that or fixed asset registers. If you bought a park before 2014, there's no cost information for this. You have to have a surveyor to go there and work out the value of these items at the time of purchase. So they're far more complex. So it does require the skills of surveyors to put a value on those items. And these claims are widely overlooked and generate substantial tax savings. The further we go away from the date, the harder, not the harder they are to make, but with transactions and so on and park sales, many parks are missing out. How much can you claim? So when it comes to a cost claim, expenditure, it's typically between 35 to 60% of the spend can qualify. So in turn, you can use a percentage of what's identified each year to reduce your tax liability, whether that's company or individual. And the same goes for purchase. The purchase of the park is usually about 20 to 40% of the purchase price of the park. And again, that creates the pool of tax savings to carry forward. The average tax relief generated per park in making a claim is around about 95,000, but it depends on the size of the park, obviously. So the bigger the park with more qualifying capital allowances on it, the higher the amount. So, but on average, there's around about 95,000 in tax savings, which are unlocked per park. That's holiday and residentials, by the way. So just to give you some examples of case studies, this was Sallops up in Mid Wales, where it was a cluster of parks, a group of parks that were sat on quite a substantial amount of tax relief for a while, and the surveyors took a look at it, and some of the capital allowances team, and generated quite a substantial amount of tax relief, which could be used to carry forward for the owners. And this was something which the accountants were not familiar with, and thankfully they spoke to a capital allowances company to make the claim. That was the capital allowances company being ourselves. But Silver Bay, I use this example. This is based in Anglesey. The accountants were a top 20 practice, and they believe they did a very good job in claiming all the allowances across the site. The owner was adamant that there was more to be claimed, but the accountants were putting the client off. The client took an independent free capital allowances review, and in doing so, an additional 3 million was identified, which was completely missed by the accountants. And in turn, this created over $500,000 in tax relief for the owner, including a very substantial cash rebate, which was put back into the site itself to reinvest. But thankfully, he didn't solely listen to his accountant's advice. And here's another example of a cost claim where, again, it was built from the park was built from scratch. So there's a lot to analyse, but there was a very substantial amount of tax relief which was unlocked as a result of making claim. So those were cost claim examples. Purchase claim examples, residential parks owned for quite a long time. Unbeknown to them, they were sat on quite a substantial amount of tax relief. So in looking at in speaking with the capital allowances company, having a free review, it generated a substantial amount of tax savings and tax relief. There's many examples that we can obviously show you of clients that have taken who have made capital allowances claims and benefited from them. But there's still, when it comes to holiday parks, this is so overlooked and misunderstood, and it means that a lot of park owners are missing out. So I would really encourage anybody with a park to, whether it's with Eureka or not, to really look at getting a free review. The capital allowances process is relatively universal. I mean, when it comes to independent capital allowances companies, there's probably a dozen in the UK. Your big four accountancy practices obviously have capital allowances departments, but if you're not with a big four accountancy practice, then it's unlikely that your claim has been done either at all or done diligently. So most capital allowances companies follow the same process. Usually, that's not speaking for all of them. They offer a free no obligation review, a fact find to explore qualification, and to obviously assess any park's entitlement. Going forward from that stage, a site survey would typically be required. A surveyor would go to the park, and due diligence would be carried out to ensure qualifications. This might include obviously checking historic land registry records. It might include looking at sales contracts, but please be rest assured that the heavy lifting, it should be done by a capital allowances team and not by yourselves. When a survey is being completed, due diligence carried out, that enables a technical team to create the capital allowances valuation report. The report is very it's quite heavy on the head. There's a lot of numbers involved with it and calculations of how these figures have been come to. But it is a very diligent report which can be submitted to HMRC, whether that is by your accountant or the capital allowances company that has completed the report. When it's completed and it's submitted to HMRC, you're at HMRC's mercy. There's no control over that. We've seen some parks turn around, within a couple of days, some a few months. I'd probably say, as an estimate, that I'd probably say 3 months start to finish. So if you've got January tax bills looming, then that would be a good time to speak with the capital allowances company to get a free review. Excuse me. So why act now? Some of you may or not be familiar with this, but the whole landscape changed. Well, the whole landscape's been changing for tax in general over the last 12 to 18 months. But unfortunately, one of the first hit when it came to capital allowances was the abolition of the FHL, the Furnished Holiday Let tax regime. It was abolished in April this year. There's still a window of opportunity for owners to make claim, but this has affected. There's approximately 140,000 furnished holiday lets in the UK, which are no longer going to be able to claim capital allowances. They've got a window of opportunity to make their claim and secure them going forward, but some industries are looking at this as a call to action to say, right, well, now's the time for me to look at this, just in case it gets abolished in this particular industry. Obviously, why act now? If you've obviously carried out work, you don't want to be losing annual investment allowance, because that's valuable. Whilst the standard capital allowances claim will allow you to claim a percentage of your allowances every year, with annual investment allowance, you can claim 100% of it. So if, for example, you qualified for annual investment allowance AIA, you had a pool of 100,000 and you had a £100,000 tax bill, you could write the whole amount off legitimately, of course. And why act now? Well, I mean, why not? That's what I would say. This is an opportunity to boost cash flow immediately. So, a lot of businesses across all sectors have had turbulent times. So why wait? Particularly if you've got tax bills coming up or year ends coming up. So we would encourage owners to take a free review. I've added just a couple of quotes from a couple of clients that we work with, which happen to be directors of certain branches, just to highlight the as Dylan's mentioned here, the process was simple, and we worked with their accountant, because I think one of the misconceptions is that there's a lot of work involved, but obviously you don't do the work. That's what capital allowances companies should be there for. They're the ones that analyze everything and work with an accountant to get this done. So it's the heavy lifting shouldn't be done by yourself. And again, Glenn and Hannah of Discover Parks, so I believe the director of the Heart of England branch, again mentions the service. Let the capital allowances company do the work. This brings me on to my final slide. Thank you for listening. I've covered a bit. I hope I haven't bored you with the subject too much, but hopefully overcome some misconceptions, giving you a little bit of food for thought in terms of what is being missed on parks. And if you haven't looked at this before, I would really encourage you to contact, whether it's ourselves as an associate member or somebody else, to look at this just assess your capital allowances and make sure you're not missing out, because a lot of parks are leaving a lot of money on the table when they really need it. My contact information is on the screen at the moment. Please feel free to contact me. If you want to email me with your park information at a time that suits for you, we can arrange a call. If you wish to give me a call later on today, tomorrow, please feel free to do so. Eureka are also sponsoring the event in Scotland, so we'll be there, and also in January. So it would be great to meet you. And I think I can move on now to some questions, and hopefully be able to answer them for you. So Brilliant. Thank you again for listening. And I'm just going to take my screen off if I can. There we go.
Thank you so much, Jason. Really appreciate that walkthrough of it. I don't understand finances and taxes and things. I'm the head of communications at Central Office, so I deal with things like the Parks Makes Places stories about people investing outside of their park gates. So this has been a really useful insight for me. Just to let people know, this will be recorded and available on the members' website. So if there's any particular questions that people might have, they want to just revisit any of the webinar, you certainly can do, and pick up Jason's contact details. There's no questions at the moment on the Q&A, but I've just got a general question, Jason. What's the timeline like from, say, a park thinks, actually, there has been some signage we put up, there has been some new work they've done on their reception, for instance, that maybe they haven't claimed for. What might the timeline be like if they started this ball rolling?
It would all depend on how well that the information is held by the owner. So if it's a company and there's a fixed asset register and they can give us the information, we can turn that around. You know, it depends on how, the closer we get to January, like, the more the workload is obviously higher. But if all the information is clear and concise, we can turn it around within usually around 2 to 4 weeks.
Okay.
But as I mentioned in one of the slides, we're at the mercy of HMRC. When it goes to them, it could be anything. But on average, the whole process, it's about 3 months, I would say. It can be quicker. The purchase claims can be a bit quicker. In reference, we can get a surveyor there. We've got surveyors that travel nationwide. We can get them there usually within a couple of weeks at the latest, and we can turn those around a little bit quicker. But overall, the whole process is usually 2 to 3 months, I would say, Alison.
Brilliant. No, that's really useful to know, I think, so people could maybe kind of put that in. And like you were saying at the beginning, it's it's free to ask. It's free to get. You can get an independent free review. You can talk to your accountant. They can approach you. There's different avenues. Why make an easy thing hard? Let's just see if those possibilities are out there for the parks, which could make some things a little bit financially lighter going into 2026.
Yeah. Well, on that note, there's nothing to lose. We will burden the work at the start to ensure that you're not missing out. And we're not there to tread on any accountant's toes. We like to work with them. Most of our referrals for the business actually come from accountants. We work with them. Some of them do get put out by, they think we're trying to take clients from them if clients engage with them, but we're not. That's not what we do. We're not accountants. We specialize in one thing only, which is capital allowances. So, upon reviewing, it does happen. We can look at a fixed asset register and tax computations and everything that we need, and we can say, good news, everything has been claimed for. So the accountant's done a fantastic job. It hasn't cost you a penny. We've done the work and they've done a good job. And that's that. So,
and you can get the reassurance and maybe revisit it again in a couple of years' time if there's been different investments and developments.
Yes, there's obviously ongoing work which we're happy to. We analyse. We've got clients that do work to parks and updates and upgrades, and we look at that every year, and that's part of our service.
Fantastic.
Yeah.
In which case, I think we're good. You've explained it all so well, Jason. We haven't got any really gritty questions here at all. So what we'll do is get the recording up onto the webinar page on the members' website. And as you were saying earlier, you and your team might be around at a branch meeting or at the conference in Scotland and in London in January. So thanks very much.
Yes, thank you very much, Alison. Thank you for those listening as well. If you would like to chat, feel free to get in touch.
Fabulous. Thanks again.
Okay.
Bye-bye.
Thank you. Bye-bye. Bye-bye.